I'm Bala Kumar, Strategy Chair for this year's conference, and I'm so excited to present the next panel of the day, Private Equity Perspective, where we will get insights into primary thoughts and concerns of private investors. And it is my distinct privilege to introduce the moderator for this panel, Mr. James Garrett of Latham & Watkins, LLP. James is a partner in Latham & Watkins' Houston office and a member of the firm's private equity and M&A practices. He counsels a diverse range of clients in private equity, venture capital, portfolio companies, entrepreneurs, public and private companies, regarding corporate and transactional matters such as M&A, divestitures, growth equity, private financing transactions, joint ventures, corporate reorganization, and general corporate matters. There's a lot to say about James. He has all the accolades, Texas Rising, Star by Super Lawyers. He's also a director at Interfaith Care Partners and a director at the Texas Hearing Institute. But I'm very excited for him to moderate this panel because he has diverse transactional experience advising across a broad range of energy industries, oil and gas, renewables, energy infrastructure, technology, as well as many other related fields. He has previously served on the founding advisory board of Greentown Labs Houston. As you can see, he's exceptionally well qualified to lead this discussion, and so it's my honor to introduce and welcome Mr. James Garrett.
I'd like to thank the student committee as well as Rice University for putting together this impressive summit and for assembling this impressive group of panelists. To my left, immediate left, to your right, is Gabrielle Alonso. Gabrielle is the president and CEO of 547 Energy, which is Quantum Energy Partners' clean tech investment platform focused on domestic and international opportunities. Prior to 547, Gabrielle was the CEO of EDP Renewables North America. Next to Gabrielle is Meg Murphy. Meg is the vice president at INCAP Investments Energy Transition Fund, which is INCAP's preeminent clean investment platform. Prior to joining EETF, Meg served as a vice president at INCAP Investments, where she sourced and monitored traditional oil and gas opportunities. So she has a unique perspective of, not only traditional oil and gas and in the energy transition space. Next is Eric Danzinger. Eric is a managing director at Riverbend Energy Group. Riverbend is a Houston-based private equity fund focused on investing in all through the energy value chain. Prior to Riverbend, Eric served as an executive and founder of multiple clean tech companies. And then last, but certainly not least, is Troy Thacker. Troy is the managing partner and co-founder of Aura Partners, a global private equity firm focused on decarbonization efforts. And Troy, for the last 25, 30 years, has led or invested in multiple sustainability projects, including being the CEO of R360 Environmental Solutions. So thank you again all for joining this panel. The first question, we go to the state of the market. And as discussed kind of throughout this program, there's been significant transition, evolution in the last couple of years. How has that evolution influenced your respective firms' investment strategies? And what in particular are you looking for? Gabriel, we'll start with you. We'll go down there.
Okay, thank you, James. Thank you to Rice University for the invite. I would say, that first and foremost, the last 2 years are relevant, but we hold a steady look into 5, 10 years away. Our view is that the energy sector is in constant transition, and the current transition is not new. There were several before, from conventional to unconventional, from coal to gas, and now we are in this transition to zero carbon energy. So for us, the last 2 years, what they meant is that there was an acceleration. The velocity at which the space moved was faster. That velocity increased, primarily driven by, I think, the volatility that we saw for reasons we all know, and the underperformance of the traditional energy sector versus the tech sector, and the belief that the capital markets developed that the energy transition investments were closer to the tech world than they were to the traditional sector world in terms of future performance. We'll see if that's true. In any event, our view is that, I mean, where we are spending the time right now is to build, and we have spent for several years the time to build a global clean energy player. So we are investing across technologies, traditional, well, I call traditional or mainstream renewable energy technologies like onshore wind, solar PV, as well as newer ones like offshore wind, both fixed bottom or floating storage. For example, we are investing across verticals. I mean, we are investing in utility scale generation. We are investing in distributed generation. We are investing in I mean, different verticals, as well as in different times within the business cycle, like development, construction, operations. We don't do everything everywhere. Of course, we are very selective as to what we think makes sense, which technology makes sense in which market, at what point within the business cycle it makes sense to enter. And if you look at the platforms we've put together lately, we believe at this point in time, if we want to escape the really low return environment that has been building up in the clean energy space, we've been entering earlier into the business cycle, launching platforms that are pursuing greenfield wind, solar projects here in the US with ConnectGen, which is a platform we launched 3.5 years ago here in Houston, or in Europe with another platform we launched there, or even an offshore platform we launched a couple of years ago also in Europe. And our aim is to do it globally where it makes sense.
Hi, Meg Murphy. I'm very honored to be here today. Thank you so much for hosting us. NCAP is a little bit different. So we've been around for a little over 33 years. Traditionally, NCAP has been known as an oil and gas franchise. We have 28 institutional funds, over 38 billion in capital raised, 27 of those in the oil and gas space. And very similar to what you're seeing really from a lot of oil and gas players is the key to often making money in private equity is adapting to the current market. And so we would be remiss not to be looking at the broader energy complex. And in 2018, we were looking around thinking, what is the third leg of the NCAP stool? Because we have our upstream oil and gas funds and our midstream oil and gas funds. And we had previously looked at petrochem, we had looked at REITs, we had looked at renewables actually before. And really what had transpired in the years before we made the decision to come into this space was massive advances in the space, but also a real push and change from the consumers and from what was happening in the market. And really the consumers not just being our investors, but public consumption. And as a part of the NCAP team, when we started to pursue what is this next leg, and we ended up looking at energy transition, part of the reason it was fundamentally a fit is it's contrary to what people seem to think. It's actually complementary of our existing businesses because we have to find a way to decarbonize the broader energy complex. And so NCAP's fund is not necessarily a renewables fund. NCAP's fund is trying to identify ways to find solutions to new problems that are created by introducing more intermittent renewable generation onto the grid. So we'll probably talk sometime today. We have a large concentration of our portfolio in front of the meter battery storage at a utility scale. Another way that we're looking to solve some of those problems is looking at how do we decarbonize the fuel sector? How do we look to solve some problems as we put more renewables on the sector? How do we think about creating opportunities to allow this transition to happen smoothly? Because often what you hear about in the market is you're either all green or you're all fossil fuels. And my favorite article headline I saw this year was in the Financial Times, and it said, olive is the new green. And I think that's the NCAP platform is how do we marry all of these together so that we can continue to make progress toward a cleaner, decarbonized future. And some people say better lucky than good. I happen to be staffed effectively on the project on renewables and have been fortunate enough to be there since we started really in early 2019.
Great. So hi, everyone. I'm Eric Danziger. I lead the energy transition efforts for Riverbend. I joined earlier this year at Riverbend, but Riverbend is a 20-year firm, really focused, not too dissimilar from NCAP, on kind of the fossil fuel, oil and gas model, a little over $3 billion in capital, 9 funds, all kind of traditional oil and gas. I joined in kind of beginning of this year to lead our transition fund, which is specifically focused on sort of the services sector of the transition. As kind of James mentioned, my background has primarily been as an operator, an entrepreneur in the clean tech space. This was before energy transition was even a buzzword, if you will. And this was kind of a thesis I'd always had, in that when I raised capital for those businesses in 14, 16, 18, the market is not what it is now. I mean, it was ugly. It was a beatdown, and but we persevered and we grew and we scaled those businesses and exited them. And I always sort of saw that there was a gap missing in kind of the service-oriented side of the transition. And so we're a fund that invests all across kind of the renewable or transition sector, whether it's decarbonization, solar storage, EV, energy management, et cetera, but specifically focused on kind of the services angle. So that's operations and maintenance, service, technology, finance, development, et cetera. And so it's kind of the shovels and pitchforks, if you will, of all the things that enable the transition. So I'm sure we'll cover more of sort of what that means, but that's kind of how the firm has transitioned and how I got to be in doing what I'm doing.
And I'm Troy Thacker, managing partner of RR Partners. We're a Houston-based private equity firm focused on decarbonizing the industrial sector. So a little broader than just the energy transition, starting to look at materials, chemicals, industrial products, green fuels, food and ag. If we look around, everything in this room fundamentally has to be remade in a lower carbon way if we're going to meet any of the net zero targets that have been set out by this school for 2038, by countries around the world for 2050, 2060. Most Fortune 500 companies at this point have made some sort of pledge towards net zero. To get there, there's going to need to be trillions of dollars invested. So I think all of us are up here talking about this because there's a lot of tailwind behind businesses that are helping decarbonize. Whether that's in the energy transition, or it's in an industrial product, or it's in a chemical, it really doesn't matter. We've got to find ways to find businesses that can make products at cost parity, but with lower emissions. If we can do that, you've got tremendous market share capture capabilities in your businesses, whether it's in plastics recycling, or it's in biofuels, or it's in energy efficiency. Really doesn't matter. All of the businesses share a common theme, which is finding ways to do things in a cleaner way.
Gabriel mentioned this briefly, but I think it's worth fleshing out with the broader team. We've heard from many clients that rates of return on renewable projects, compared to, say, traditional oil and gas opportunities, are lower, or can be lower. What approaches are your firms taking to ensure acceptable rates of return for your LPs? Troy.
Sure. So first off, we don't necessarily invest just in projects. We're investing in businesses. And fundamentally, so back on what I was saying, so if you make a product at the same cost as everyone else that can make that product, and you can do it in a way that has lower carbon emissions, you should be able to take market share aggressively, which means you can fundamentally remake an industry or a category. And so I don't know that we've seen rates of return drop within the types of businesses that we're looking at. Certainly on the project level with solar or wind, those projects have lower rates of return because I think the technology is well understood at this point. There's great terminal value in those businesses as opposed to maybe conventional hydrocarbon investing today. But as you're building organizations, building businesses, I think you can create exceptional returns.
So I'll echo a little bit what Troy said. I think, looking back 10 years ago when folks were investing in the space, you had a lot of venture capital. It was kind of the way that those were the firms that were investing in clean tech 1.0. And looking back on sort of lesson learned, venture capital is, we'll invest in 10 companies, 9 will go completely belly up and 1 will be a home run. And, they're not necessarily patient capital, it's high growth. And so having those types of investors or investment themes investing in kind of energy transition renewables probably wasn't the right risk return profile in terms of return on capital, et cetera. Coupled with, the other people investing in the space at the time was a lot of sort of like projects, like Troy said, so like utility scale projects that are low single digit returns. And so we felt, and where we're investing is kind of operating businesses, cash flowing, good, businesses that, may or may not make a profit, but have revenue, in many cases are cash flow positive, et cetera. And that really didn't exist kind of the first time. So there's a pool of companies and opportunities to invest in that really didn't exist several years ago. I mean, some of the biggest renewable sort of finance companies, et cetera, they don't make any money. And there just was a gap, I think, in terms of what people, the right profile. And I will even say from somebody that's out, raised a fund and raising a fund, even energy transition, there's kind of a like, where does this live? There are some LPs and endowments that say like, great, we're going to get you in touch with the natural resources team. It's like, what? That doesn't make any sense. We're not investing in natural resources. Or, oh, you make sense for the private equity group. It's like, well, they're looking at firms like us, but across healthcare, telecom, et cetera, et cetera. So I think people are still sort of figured out, but the broader sort of like risk return profile of operating energy transition businesses didn't exist 10 years ago. It was either pure venture, pure kind of project development. And so it's still being figured out.
I think for NCAP, I can certainly speak for myself. I had a preconceived notion that renewables just lost money. And so when I first got the project, I was like, I don't know about this. And since then have been proven wrong. And part of that is really very similar to what I was doing at NCAP and what we've been doing in our upstream and midstream businesses, which is it's all about, at least for the investments we're making, where you are in the life cycle. If you were buying a PDP blowdown asset in oil and gas, it would not have returns too dissimilar from the investments you can make in certain renewables projects. What we do to achieve our returns is we are taking some development risk, meaning we are not a suitable provider of capital to build, own, and operate a solar plant today. Not because it's an uneconomic plant, but it's simply not a fit for our cost of capital. What we can do, though, is identify and build projects to the point that they are shovel ready to then sell to the ultimate owner operator of the project. And you've got the boots on the ground going to identify the best places. Why are they the best? What's transmission? Are you solving a problem? Are you creating value in the location? Are you getting contracts in place? And there are large swaths of capital that want all that minutia done so they can just execute. And that is a place that we can play. And then also you're finding opportunities where there are, I hesitate to use the word emerging technologies because we do not like binary technology risk. We are not venture capital. We truly need proof of concept. And so for us to achieve our returns, sometimes it is the implementation of that technology or our strategy. So we have we have a very large presence in utility scale battery storage, as I mentioned, but we also have a company that's doing solar, rooftop solar and solar plus storage for commercial and industrial customers, and they're aggregating a large portfolio. And it's that aggregation that's going to achieve the rates of returns that we're seeking, not necessarily the project level. So, I'd echo what Troy said, where the value of our businesses as we see it is the platform. It's operating assets, a pipeline for future growth, and a team that has demonstrated the ability to execute on those assets.
I would say that when people talk about low returns for renewable energy projects, sometimes I'm comparing those with more traditional opportunities. I think we are not comparing those. It's not an apples to apples comparison. I think if you look at risk-adjusted returns, I personally think that they are not that dissimilar. At the end, one of the key reasons wind and solar have grown so much over the last 10, 15 years is that we have all benefited from interest rates coming down. And the fact that wind and solar were securing 15, 20-year contracts, offtake agreements with fixed price of electricity was viewed as a really safe investment. So returns came down because they were because on a risk-adjusted basis they were seen as a very attractive return. So I think that may be slowly changing in an inflationary world. I mean, having a fixed price electricity when commodities around you are going up, it can move against you. But I think that's something that, yes, on absolute terms, it was lower, returns were lower. We don't invest in projects either. We also decided that it made sense to take incremental risks and move earlier in the development, in the business cycle, and enter earlier and identify those sites that would make the most sense to address the biggest problems that the industry is facing today. The biggest problems are, for example, transmission capacity. I mean, the lack of ability to move all this power that we all want to generate and deliver it into load centers. Because again, and this is something very important to understand, that at the end, wind, solar, no matter whether it's offshore wind or even onshore wind, this is nothing but a real estate plus technology game. Okay, there are two key components to it, and there's not a fuel we need to chase that we need to burn or anything. It's just real estate and technology. So when you have when you produce a commodity and you're dealing with mixing, intersecting two commodities, real estate and technology can be commoditized quite early. You have to find ways to create value. I would also say that another way you can escape the aggressive return environment is by actually being a little bit of contra natura. So we are producing intermittent electricity. Okay, find ways to actually adjust the shape of your power. If you can create a product that will follow load, that product will carry a premium. That product will bring you additional returns. There are multiple ways where you can find specific strategies that can lead to higher returns than the average ones the market is getting for operational projects, because like Meg was stating, we also don't have the right cost of capital to compete for those operational projects.
Pivoting to exit strategies, over the last 15 to 18 months, we've seen a significant amount of IPOs, SPACs, particularly in the energy transition space. Where do you foresee the exit opportunities in the next 15 to 18 months? And relatedly, how are you valuing terminal value for your investment platforms? Meg?
I saw a stat recently in one of these updates that Reuters put out that there's $2 trillion chasing sustainability and ESG right now. So do that math on the buyer universe. The question becomes, who is the right buyer for these platforms? Because the point of making the investments is to decarbonize the economy and make an impact and make a difference. And so for us today, we're seeing strategics involved, financial players, the public markets do seem to have an appetite. The SPAC attack is happening. There's some real volatility there. So I'll hold my comments on that exit. I think if it works, it really works. And if it doesn't, it really doesn't. But the buyers are really going to be, frankly, the people that want to take the assets to the next step if you're in the PE stage of life or want to be the long-term owner. And I think right now there's a broader mandate out there to clean up and decarbonize. So ultimately the buyers for some of our assets could even be oil majors. I mean, that's been the biggest emerging buyer universe. Shell, BP, Chevron making these announcements could be some of our partnerships. And we're even seeing some synergies across our three platforms where midstream businesses need to clean up their emissions. Well, what better? They're going to put solar on their sites. They're going to have CO2 capture that they're, growing farms around them, or they're capturing and using it for, industrial purposes. And I think that evolution over time will change who the buyer universe is. But, today for most of our assets, it will likely be strategics and financial players, but it all really depends also on the cash flow profile of the assets.
I'll echo what Meg said. I think and hope that it is a lot of the strategics, just like LPs and limited partners, endowments, pensions are trying to figure out how do we become, more energy efficient, with their pool of capital. Same thing's happening at oil majors. I mean, really any company, airlines, et cetera. And so they're either going to invest in new technologies, invest in new products, or they'll buy companies. And so whether that's companies like ours or that we're investing in, I'll take the bait on the SPAC comment. I mean, We've not done a SPAC. We likely won't do a SPAC, and nothing against folks that have. I mean, my fear and concern with SPACs is I just don't want to stand up where we did 10 years ago, where there's a ton of money lost. I mean, the way I view the SPACs is there's going to be a pool of people that make an insane amount of money, and there's going to be a pool of people that lose an insane amount of money. And then you kind of have this blanketed, I mean, when I've been in clean tech so long, people have said like, oh, I knew that company Solyndra, which like for most people is like the one where, you know, they showed up to work and the doors were locked. It's like, great that that's your image of the solar industry. But like, that's my concern a little bit with SPACs, is that the incentives are so much focused on the sponsor doing any deal versus a good deal. And you've seen probably some of these valuations of these companies. Some of that slowed down a little bit with the availability of PIPE financing, but I think the biggest sort of entrance into the space, I mean, there isn't a company, whether you fly airplanes, you manufacture and drill for traditional oil or make these tables. I mean, every company is thinking about a way to do it in a cost-effective, carbon neutral way. And so that creates a buyer universe for anything. So we'll see.
Here's hoping.
Yeah.
So I think I'm gonna echo a lot of the same stuff. So we have just 15 companies today, but and most of our companies are relatively young, some of which we started, in our offices. But we have contracts, often 10, 15, 20-year contracts with mostly Fortune 500 companies, whether it's BP or Shell or Royal VSM or Waste Management or ITW or Procter & Gamble and Unilever. I mean, it's kind of remarkable that these businesses, these big companies, are willing to sign 10-year agreements with companies that were started up 6 months ago. So I do think that there's going to be strategic exits, but at the same time, I think many of these companies have growth prospects that the public will value more highly than strategics. And maybe that's why the SPACs were so active earlier this year. Many of those businesses, I think, we're all going to get a second chance at the apple. But fundamentally, as a private equity investor, I've always believed that you don't build a company to exit it, you build a company to make it great. And you build a company that has sustainable competitive advantages, sustainable cash flows over the long term, and that exit's going to come from you. And if you do that repeatedly, the strategics are going to notice what you're doing earlier. Maybe those exits come find you faster. Sometimes it's financial buyers. We just sold a big business to BlackRock a couple of weeks ago, and it was a transaction that I've never seen people move so fast. We went from a phone call to a closed deal in 4 weeks. Just kind of shocking, yeah.
I would say, if you ask me what I expect that will happen in terms of exits over the next 18 months, I think that what we are seeing right now is there's a lot of demand for platforms that have pipeline of opportunities. That's driven by the fact that the operational assets are really expensive, and there's a lot of money out there. Investors they're sitting on top of a lot of capital. So I think what is happening right now is those investors will pursue and acquire these platforms, invest a lot of money, build that operational capacity, and then more than likely, I would expect IPO those companies. Some investors have even more money than the ones that are chasing these platforms, but they are having the challenge of buying a large strategic player. They are trying to build what I would call a big green player. And so what is happening is that those that have a lot of money, more than likely, they will end up buying multiple platforms in different strategies, in different technologies, in different regions in the world, and maybe a few years later build that big player, big green player, whatever color we want to put it. I would also say that then what's next after that? Maybe I'm going maybe too far from here, but I would predict that the strategics will find themselves with the difficulties of actually growing at the pace that somebody that buys growing organically at the pace that others are growing by buying different platforms. So I would expect that that third round of exits, we will see a lot of consolidation, but maybe 6, 7, 8, 10 years away. But
Eric mentioned this briefly about 10, 15 years ago, significant value destruction, capital destruction in clean tech. You know, what lessons were learned then that are being applied today to ensure we don't have a similar result?
Number one, I think Eric mentioned, I think it's very important, is the type of capital that was investing and chasing some of those opportunities was not the right one. But I think there was a fundamental one also, which is that a lot of the growth that supported Climate Tech 1.0 was driven by government providing for the right schemes. As soon as the crisis hit us 10 years ago, those governments had to build their own Maslow pyramid and identify the basic needs and what else was not as needed. And in the what else was not as needed were those programs that were removed, and that created a lot of big adjustments in the space. On top of that, to make it a perfect storm, suddenly the energy space goes through the shale revolution. So when you have nowhere to go, and on top of that, thunders start hitting on top of you, that was a big problem and a big readjustment for the entire industry. So I would say that if you ask me, the big lesson learned is that you need to build, in order for you to be sustainable, for you to be a vibrant sector, you have to focus on the fundamentals. And if you are exclusively relying on external support to make your business case, I mean, you are not building a sustainable space.
Yeah, I mean, I would add, Clean Tech 1.0 is really driven by the coasts, which are great at making investments in internet companies and software businesses. This is hard. I mean, you're building infrastructure. These are capital-intensive companies, and frankly, they just don't really fit the venture model, in my view. It's hard to get a technology mature enough to license it, and most of the business plans from 06, 07, 08 had a licensing component. They thought they could get it out of the lab and license it to Exxon, and Exxon would build 20 plants overnight. It just doesn't happen. There's a lot of capital that has to build those first commercial facilities, or the first real facilities that can demonstrate the cash flow characteristics of the tech. So I think that's what happened personally, and I agree with you completely. Then you had oil prices and gas prices drop, which made a lot of those things that were just becoming potentially economic no longer economic. And of course, we had the great financial crisis. So lots of things conspired last time.
I'll add, I think they've covered all the same things, declining. The other two things I would add is declining costs. I mean, if you look over the last 8 years, the cost of lithium ion or photovoltaic, I mean, way down, cost comparative without government subsidies, et cetera. The other is, I think, just general like market awareness, appreciation on climate change. I mean, 2012 to 14 or so, I mean, Tesla and people that had Teslas and had solar and had batteries, I mean, it was a rich person like toy. I mean, and so now that's become, I mean, you can point to, the Paris Agreement, whatever, all the different things, or Snowmageddon. I mean, it's climate change has caught the attention of not just people, but big organizations, and it's hard to ignore that it's not a real thing. So, I think you add all that in, plus the right allocation of capital and, the right time horizon, the right, interest. And you do, I will say, you also you have a lot of, market movers, if you will, being big allocators of capital, saying, we don't care what the return profile is in fossil fuels. We will no longer invest in that asset class. So when you make up, and that's, being from somebody who's out fundraising and out fundraise, that's a pretty ubiquitous comment across almost every university endowment. We understand there's money to be made in fossil fuels. We won't invest in it. Go find something else. So if you make that statement, it creates this kind of wave of innovation that says, okay, I'm going to go create something in the space that, there is interest in growth. And so I think that helps. All those things make it, different this time around.
I would say, to me, the reason I also believe Climate 2.0 is different, at least when I look at maybe more proven technologies like onshore wind and solar, is that may sound a little bit presumptuous, but these technologies right now, these forms of producing new electricity are the cleanest, obviously, but they are also the fastest and the cheapest. So if you're a government, as many governments looked at the crisis that they thought was building up during the pandemic, and you want to find ways to recover your economy quickly, I mean, building a solar project or a wind project versus an alternative zero carbon technology like nuclear is not a complicated answer you may come up with. So, and then it's the cheapest. If you look at the auctions, the way these 15, 20-year contracts have been awarded all over the world, you don't have to focus in the US. I mean, it's mind-boggling that you can see in Zambia, Africa, people willing to sell solar for 4 cents, $1 per kW hour, and do it for 3 in France, or do it for less than 2 in Portugal. I mean, it is a cheap source of electricity. So, and this is important, that fundamentally now it's easier to support, the level of public support behind some of this clean energy is there, but it's easier because the cost to your pocket is not there currently.
Pivoting briefly to fundraising, and hopefully we can get to one of these questions at least. Every week, literally every week, we're seeing a new fundraise or a new private equity fund, venture capital fund, marketing on social media. They raised X amount, millions or billions of dollars solely focused on clean energy. How are the conversations going with potential investors? And in those conversations, do you feel they're, focused mostly on just allocating to energy transition, or really diving into, generating alpha on the returns?
We just had our final close on our first fund this past April. We conveniently launched it January 2020, right before COVID. So the whole thing was virtual. Everyone was rebalancing portfolios. So just a nice twist to go out with our first energy transition fund. And we actually experienced the same thing that we were just talking about, which is, where do you put this asset class? So we have probably over 60% of our investors are our traditional oil and gas investors that we're trying to find a way to green up their portfolio or get exposure to a cleaner portfolio, if you will. And then we had traditional renewables funds and infrastructure investors, but we were a little too expensive for them because they really are the long onlys that are holding and building. I think as we were in our fundraise, at least, the questions were very different depending on who we were talking to. If you were talking to previously an oil and gas investor, they said, how are you going to protect my capital and not lose money? Because they had Climate 1.0 in their minds. If you were talking to somebody that had experience and had made money in clean tech, conversation went a whole lot better. We had exposure to front-of-the-meter battery storage, which trying to explain that to some of our LPs was like speaking in a foreign language for some. So that made it a little trickier. But honestly, the conversations were all about, what are you doing to be clean, sustainable, but how are you going to make money? And I think that's a misconception a little bit in the market. I think not everyone is chasing capital at, just completely irrespective of what the returns are on that money. And that will only last for so long, because everyone wants to be green, but they're not just going to continue to take firefighters' pension plans and flush them for the sake of being green. And so I think the true winners will be the people that do make money or do make returns on that money. And to do that, I think for our fund at least, the value is the fact that the 4 managing partners had spent the better part of their 30+ year careers at operating companies, managing through the risks that were in Climate 1.0.
Yeah, I mean, we're similar when we're in the middle of our fundraising, and I would say of two buckets of people. I mean, the traditional sort of endowments, pensions, et cetera, in terms of like generating alpha, I mean, if you had just invested in the S&P, for the last year, you'd be up. So I don't know that there's a concern. I mean, I've read about a number of pensions that have had record returns this year, and that's, a lot from either some interesting co-investments, but a lot of it's just the public markets have been up. So they have the ability to sort of be late to the party, so to speak. I mean, a lot of them said this is kind of feels like the 80s of the oil and gas private equity landscape. I mean, there's early innings here. So a lot of them, it's like, we're totally okay to sit on the sidelines and kind of watch and see how things play out. But a lot of them, it's more, they want access to kind of market intelligence where things are going. We've also added the second bucket, I would say, of kind of some, what I would call kind of strategics. They absolutely want alpha, and like, this is not I mean, it's an investment they want to return, but they're also interested in where's the market headed? As we think about developing our business model, if you guys are looking at deals where, a lot of times groups have corporate venture groups, I mean, they're in it to make money, but they're also in it to sort of navigate the lines of business. What's working, what's not working, where should we be spending our efforts? And so we've just seen a lot of kind of traction in those buckets.
Pivoting real fast to one of the Q&As, I'm going to put you all on the spot. How do you weigh when you're building a business? How do you evaluate the risk of building these businesses that are dependent currently on government subsidies?
I'm happy to take that first. So we typically won't. We're happy to take the government subsidies if they're there, but typically we're not looking for businesses that are wholly dependent on them. If there is a strategy that is behind a very robust regulation, maybe it's a carbon, I see lots of questions about carbon capture. I think the 45Q tax credits are real. I think those are going to be here for a while, and I can see potentially building a business behind those. We're willing to take some regulatory risk over in Europe, where the regulatory environment is much more stable. I think the EU exists only for climate change. So certainly there's a series of regulations there that we can get behind. But generally, making your investment returns purely upon tax credits or regulatory environments is scary business. And we're back to the fundraising comment. We're not in the business of philanthropy. We're in the business of making money.
I would say that if you are in the energy space, you are in a regulated environment. So, I mean, I've heard a lot of people talk about the concept of let the market decide, and with one hand, and with the other one asking the state PUC to help them because they need some sort of support to get their business going. So if I am building a business developing wind energy, solar energy in the US, I am relying on regulatory support, whether that's at federal level or at the state level. And as part, it's fundamental to my business model to participate in those forums where other sources of technology will make sure that they get their own fair share of support. So yeah, I mean, this is happening. And when you get governments in other countries that are procuring 20 years wind power or solar power, and they do it through auctions, it's a competitive process, but they give you the benefit of a 20-year contract in exchange of a fixed price of electricity, so everybody wins. That's a centralized way of procuring power that helps and helps the industry. So I'm not going to pretend that anybody that invests in clean energy development generation is doing in a way that it's immune to the regulatory environment around you, because you're not.
Thank you all. Appreciate it.
Thank you. Let's give our panel a warm round of applause. Very insightful discussion, and now we'll be having a 15-minute break before our next panel. Last and final one of the day.